Next article, Brian, we got to talk about mortgage refinance demand, 94% higher than a year ago. That sounds like a crazy number. It's true. That is actually down from 150%. Since we're talking about inflated and conflated statistical numbers here in this segment of the show, mortgage rate refinance demand, 94% up from a year ago. Duh. We saw this. Rates went down in August. This seems like a super layup, slam dunk. I want to talk about, though, the impact of this carrying into the fall. We were talking about how we think there's going to be more activity because behaviorally there just seems to be a wave of people who re-piqued their interest, and they are like looking at housing as something they want for a variety of reasons, politically and personally. But, I mean, look, man, the refinance numbers don't lie, and I know, like you do, some of this is people fixing their financial problems.
Oh, yeah, definitely.
Whether I like it or not, whether our comment section likes it or not, that people are using their house to cure some financial issues, hey, doesn't matter whether you care or not. If it's fixing something in their life, they're still doing it. So
no, 100%.
Go yell at your neighbor, I guess. I don't know.
Thankfully, we just closed on a cash out refinance for a client that's going to be wiping off all their debt. And I actually had an example about, the refinance. So we have a client that I've been speaking to. We closed last year. They had a 1.0 buy down. The rate got bought down from 6.99 to 5.99,
okay.
Last year.
Just for a year, though.
Just for 1 year. Okay. So it's adjusting this year in December when their first payment was made. So essentially, they have, we told them, hey, in a year, rates are going to start coming down. And, 6 to 8 months, we're going to start tracking rates, seeing where they're at and seeing, when the right time to make that jump. We started, we talked last month, briefly kind of gave them some numbers, came up with an idea, kind of formulated a plan. And I told them at the end of August, let's regroup, let's run the numbers so that in September, we can get everything in line, your application, your paperwork, have your loan submitted, or at least start shopping for a home for your refinance so that as, we move into the later months of September when, the feds are anticipating to have a rate cut and we start seeing more data come out, we start seeing how the market takes that into consideration, then we're going to be in a really good position to move very quickly on your refinance at the time that rates drop to the to the levels that you guys would like it. Anything under 5.990, they said that it is good. They're okay with that, or just being at that payment so they don't go up 1 full percent. So
what? Tell me real quickly though, because I don't want you to just keep like blast past the point. Cash out immediately. People.
Oh, this is a rated term.
Cash. Oh, I thought you said it was cash out.
No, that was just another example. So no.
Okay.
So to clarify, this exact example that I'm talking about is for a refinance, a conventional rate and term.
Understood.
And they're simply going to be taking that rate down, or not allowing the rate to go up 1%, and they're going to be additionally saving anything that's under that 5.90 if we're able to lock it in.
They're basically securing their note when they hadn't had it secured before it was going to adjust.
Yes.
So, but quickly though, go back to the cash out. So because I know people, it's it's a point of contention. But why would you take cash out of your house? Look, I know not everyone agrees. Sometimes people make bad behaviors. They have bad behavior spending wise, and it just causes problems. And if your money, your income can't cure it, and you made some bad choices, sometimes the house is there as kind of a relief valve to relieve some pressure. But we've seen time and time again people we talk to that are saving anywhere from $400 and $500 a month, like $1,300 a month. And I'm saying saving because it's out-of-pocket savings difference of paying your mortgage that's at a low rate, plus all this credit card debt, car loan, student loan, medical bill stuff. So I understand, but you have to take the long view once again. Like they could also cure that debt by selling their house. They're just choosing not to sell it. That's still the house doing the heavy lifting of paying off the debt. That's my argument. But in this case, Brian, like tell me real quickly, like what is going on that they were doing the cash out right now versus just a rate and term, whatever?
So they came to me because they had accumulated over the last couple of years a lot of credit card debt, a lot of just personal loans here and there. So for them, it got to the point where I'm like, yo, we have enough equity in the house. We're paying, I want to say they were paying close to $1,800 and just residual monthly debts for credit cards and all that.
You mean like personal debt obligations?
Personal debt obligations on top of their mortgage and car payments and stuff like that.
Okay.
So for them, they got to the point where like, hey, we have enough equity, we just want to cash out and basically just pay for everything, put it all into the property. They were at a 5.75 rate when we did their purchase about 2 years ago. We locked them in at a 6.250, and this is where I'm advising my clients to leverage the high rate, knowing that it's on the way down. Because if you have the equity, you can tap into your cash. Your rate's going to go up maybe by a quarter to maybe an eighth of a percent, but in 6 to 8 months to maybe even a year, you'll be able to refinance that a little bit lower, still take your cash that you needed at that time, and then save more on your monthly payment.
Did they happen to use some of their equity to pay for buy down or no?
No.
They could have, right? So
nothing.
it could have stayed at 5.75.
They could have, yeah. Virtually they could have. They
could
could have paid maybe like a point to 0.75%.
What's the out-of-pocket exchange they're making? Because if they're paying $1,800 of just personal debt obligations every month, but their mortgage payment goes up in the loan amount and it goes up in the interest rate, what was the exchange there?
Oh, so their savings is still like $700.
Okay. Oh wow.
So yeah.
Okay.
So I mean, from cash that was going out.
That's what I'm saying. Total out of pocket is
exactly.
a difference of $700.
Yes. Yeah. So I mean that going right back into their pockets and no extra
no
debt
consumer
payments.
debt.
Exactly.
Yeah. Okay.
And that's more or less, what I try to explain to my clients, that's where the power is at. That's where the leverage is at. We had an inverse situation of that where a client wanted to cash out refinance. They spoke to a financial advisor. Their financial advisor completely told them, hey, don't do a cash out refinance, do a HELOC.
Right.
The difference is, and I researched this, is that, depending on what you utilize that HELOC for, certain tax, deductions alternate as well.
Interest cannot be deducted depending on what you used it for unless it was for capital improvements on the property.
Exactly. So in this case, none of that was, done. It's same thing to pay off debt.
Yeah.
So,
that may or may not be a bad strategy. I'm not going to side with him or you on this. I'm just saying
that's the point that I was trying to drive home. That I said, well, in your life, what's the best, what's the best solution for the problem? You have two of them already.
Yeah.
So either way is going to solve your problem.
You're rocking two problems right now, dude.
But they, I told them, look, what's one thing you're always going to pay, regardless?
Yeah.
Your house, right? That's the main thing, your main payment, right? Now, you're still going to pay your house, but additionally, you're also going to be paying your HELOC for whatever you use. Down the line, you're going to have to either pay that off in full or refinance it into your property. So I said, whatever way you take, I just want to make sure that you solve your problem. But I will let you know that if you don't have that lump sum right now, what's the chances of you having it later?
Yeah, let's say you're expecting some sort of windfall event. You're going to come into some inheritance money, or you're selling something else like a business or whatever. Like that could be a case for making an alternative choice. But if you don't have an alternative choice, I totally understand.
Yeah.
This. The other thing too, and I'm going to say this, is that when it comes to your financial planner, there's also a lot of other assets in play.
Yeah.
You may not know what they got in their 401k, their IRA. Is it rollover? What time? How old are they? When are they retiring? Like there's all sorts of other stuff. Maybe they have a plan to retire and move out of state. So in 3 years or 5 years, if that's the case, and may not be.
No, of course.
My argument is there's a point where that's fine that the financial planner has that take. That's fine. You can still do the transaction, help them save the money.
Yeah.
Doesn't matter. In the end, it doesn't really matter. No, because the client still needs the help.
And that was my point, regardless. I told them, look, whatever decision you make, as long as you get your problem solved, that's all that matters, man. I don't want you to do something that you don't want to do, but if that makes sense for you, take that.
I think that we're going to continue seeing numbers like this with refinance demand being high, partially because the numbers were so low last year, but partially because of the uptick of activity with rates going low. And then once the Fed has their rate cut in the middle of September, that's going to, again, they're not directly connected to the mortgage market, but it influences and plays into it. That's going to, I think, draw more people in to go, okay, cool. Now rates are down another 1/4 or 0.5% on the mortgage side of things. Now that's my strike point. It makes sense for me to do this. Let's make the move.
Yeah, and very simple. Don't wait to get ready when rates drop. Get ready now and wait for rates to drop.
Yeah, be ready.
You're going to be in a way better position. And I'm going to keep driving that point home because it's like, trust me, once things start dropping, you're going to see from 1 week to another applications spike up, competition go up, more houses are going to start hitting the market, and by the time that you want to get ready, that property's probably already sold, that transaction's already done, people are already getting into contracts, so you're going to have to wait for the next wave.
The way I've been looking at this is like waiting for an Uber ride to go to the airport on vacation. Like, when do you start packing? When the car's already there or before the car shows up?
And
start packing now.
And now you have the ability of putting a timer when you want to get picked up. So I mean, like, the planning is there, hey, I want to refinance in 6 months, maybe I should start getting ready in month 2, 3.
Yeah, I know that in the past, when back when I was still doing a lot of loan activity, I had people like, well, what if I do that now and it gets even lower in 6 more months? Like, I have no clue if that's even going to happen. Neither do you.
No, I don't have no crystal ball, which I wish I had.
Yeah, and it's not just that. But you know what it really came down to, and maybe this is for somebody watching this segment of the show. This part of it is maybe it just comes down to this: like, in which way will you be dissatisfied? Are you going to be dissatisfied that you locked your loan today and it's lower tomorrow? Or will you be dissatisfied even greater if you floated it today, instead of locking a lower rate, it goes higher tomorrow and you missed out on the one you had in front of you? So, pick which way you're willing to be dissatisfied and then make your choice from there. That's literally how I had to tell people sometimes.
Positively dissatisfied.
Yeah, but because it was coming from a place of I don't know what's best to do in this situation. It's uncertain to me a little bit, and so I had to reframe it. I didn't need anything out of it by reframing it. It was to help the client make a choice because he was struggling. I don't know what to do. I said I would say you lock it today because we don't know what tomorrow, and here's why I think that. And he's like, well, yeah, but what if it da-da-da? I said, listen, what do you want to call me and be mad about tomorrow? That we floated and it's higher or that we locked it and it's lower? He goes, I'd be mad if we floated and it was higher tomorrow. I said, okay, well then let's lock. He goes, you know what? Yeah, let's lock. And I didn't need it to lock today or tomorrow. He just asked me the question. I was like, he's just coming from a place of uncertainty and kind of pre-admitting how he was going to be dissatisfied one way or another. And then he was able to make his choice. So
I think that's a great way to put it. You don't tell them what to do, but you give them the options of what they can do.
Yeah, I can't.
It's a tough cookie because I've been in that position too, where they're asking me, well, what should I do? And it's like, it's not so much saying, hey, you should do this, but rather giving them like the pathway and the way, like, hey, well, these are your options. Where do you? It is
our job to have that conversation. Yeah. Though it's our job to have the conversation and answer the question when we're asked the question. I can't do it for him.
Yeah.
But I had to help him understand like what choice he was making, what the consequence of deciding or not deciding were, and that's true for everybody. And some people are like, hey, whatever, I don't care. So a lot of it had to do with more of the personal behavior.
Yeah.
And again, maybe this is for somebody who is feeling that same way. Well, there you go. You can ask yourself that same question and make the choice that's best for you and your family given that circumstance.
That's always the best decision you can make.